83% of Americans say they are under financial stress. 77% report feeling anxious about money. And according to a Harris poll from the spring of 2025, roughly half of American adults, 53%, feel like no matter how hard they try to get ahead, something always comes up to set them back. Here's the part that will break your brain. The Federal Reserve's data, released in late 2023, shows that the median American household net worth is $192,700. That puts the average American household in roughly the top 30% of global wealth. And if you own a home, have a retirement account, and have been paying into Social Security for more than a decade, you are almost certainly sitting on far more wealth than you have ever calculated. You have been measuring your money wrong, and I am going to show you exactly how. This video is not about telling you everything is fine. It's not a comfort blanket. Some people genuinely are struggling, and I'm not minimizing that. What I am saying is that a massive number of people watching this right now, are wealthier than 80% of their fellow Americans and don't know it because they have been looking at the wrong numbers, comparing themselves to the wrong people, and completely ignoring 3 sources of wealth that never show up in their checking account. By the end of this video, you are going to know exactly where you stand, and you are probably going to be surprised. Here is the metaphor I want you to hold on to for the entire video because it explains everything. Imagine you own a store. Every morning, you check the cash register. You look at what came in last night. You look at today's balance. And based on that number, just that number, you decide whether your business is doing well or badly. You completely ignore the building you own, the inventory on the shelves, the equipment you paid off 3 years ago, and the long-term contracts you signed with your suppliers. You run the whole business off your cash register reading. That is exactly how most Americans think about their personal finances. They check the bank account, maybe the credit card balance, and that's it. Everything else, the equity in the house, the retirement account, the government pension you've been paying into for 20 years, it's invisible. It's on the shelves, but they never count the inventory. I'm going to call this the inventory problem. And I want you to keep it in mind every time I introduce a new number, because every number I'm about to show you is something that most people have, but almost nobody counts. Let me introduce you to someone. I'll call him Mark. Mark is 47 years old. He lives in Ohio, works in manufacturing, makes about $72,000 a year. He has a mortgage on a house he bought in 2012. He has a 401k through his employer. He has been paying Social Security taxes since he was 23. And every single month, after he pays his bills, he looks at what's left in his checking account, maybe $900, sometimes less, and he tells himself the same thing. I have nothing. I'm one bad month away from disaster. I want to come back to Mark at the end of this video because Mark has a secret he doesn't know about yet. Stay with me. In a few minutes, I'm going to show you the most counterintuitive thing about American wealth, a number that completely rewrites the story you've been telling yourself. But first, let me show you how broken the perception gap really is, because it's even more broken than you think. The Charles Schwab Modern Wealth Survey from 2024 asked Americans a simple question. What net worth does it take to be considered wealthy? The answer? $2.5 million. The average American believes you need $2.5 million to be wealthy. Here is the problem with that number. According to the most current wealth percentile data available, you need $11.6 million to be in the top 1%. You need $2.7 million to be in the top 2%, and you need $1.17 million to break into the top 5%, which means the average American has set their personal definition of wealth at a level only the top 2% of the country can reach. Everyone below that line, including most people who are objectively, statistically, measurably well off, walks around feeling like they haven't made it yet. This is not accidental. This is how the brain works when it processes relative wealth. Behavioral economists call it the reference point problem. You don't evaluate your financial situation in absolute terms. You evaluate it relative to the people you see around you, the people in your social feed, the lifestyle you think you're supposed to have. And in a country where the top 10% own 76% of all wealth, where the average net worth is more than $1 million, distorted beyond recognition by billionaires at the top, the average American's internal compass is completely miscalibrated. You are comparing yourself to a version of normal that almost nobody actually lives, and you feel like you're losing a race that was never real. There's a parable I think about when I hear those Schwab numbers. Picture a town with 99 people earning $30,000 a year. Then one person moves in who earns $300 million. The average income in that town just jumped to $3.3 million. Every single original resident now earns below average. Nothing about their lives changed. Their rent is the same, their grocery bill is the same, their paycheck is the same. But suddenly, statistically, they're all below average earners. That's what's happening to American net worth perception. The Elon Musks of the world didn't just accumulate wealth. They distorted the math so badly that people with $400,000 in assets feel like failures. And here's the thing that nobody talks about. The median American household net worth rose 37% between 2019 and 2022 in inflation-adjusted terms. That's the biggest jump since the Fed started tracking this data back in the 80s. The middle of America got meaningfully richer. And the majority of those people still feel broke because the reference point didn't move with them. The Joneses upgraded too. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Now, here's where it gets really interesting, because the perception problem is one thing, but the inventory problem I mentioned earlier is a completely different beast, and it's the one that is actually costing you right now in real psychological dollars. Think about what you consider your wealth. If I asked you right now to write down your net worth on a napkin, what would you include? Most people write down their checking account, their savings account, maybe a brokerage account if they have one. Then they subtract the credit card balance and the car payment and whatever's left on the mortgage. The number they get is usually depressingly small, sometimes negative, but they forgot the shelves, they forgot the inventory. The single biggest invisible asset on the average American's balance sheet is home equity. And the numbers are, to use a technical term, enormous. According to the Intercontinental Exchange Mortgage Monitor from March 2025, the average homeowner currently has $313,000 of equity in their home. The data from Cotality, reporting on the third quarter of 2025, puts total homeowner equity for borrowers with a mortgage at $17.1 trillion. That is $17.1 trillion of wealth sitting in American homes that most homeowners never think about when they assess their financial situation. And nearly half of all mortgage properties, 46.2% to be exact, are what the industry calls equity rich, meaning the outstanding loan balance is less than half the home's value. So the house is worth twice what is still owed on it. That is a massive asset, fully paid, and people walk around feeling broke because their bank account is thin. Now, you're asking yourself, but that equity's locked up, I can't spend it. And that's partially true, but net worth is not the same as liquid cash. A pension fund manager doesn't look at your defined benefit plan and go, well, you can't spend it yet, so we won't count it. It counts. It is real wealth on a real balance sheet. And in the context of this video, comparing where you are relative to other Americans, your home equity counts absolutely. Because the people you're comparing yourself to, the ones who make you feel poor, many of them are also counting their home equity. They're just not telling you about it. Here's a number that will reframe everything. The Census Bureau's Survey of Income and Program Participation data shows that in 2022, the median renter household net worth was $10,400. The median homeowner household net worth was nearly $400,000. That gap, nearly $390,000 in 2022, is a direct function of home equity. This is confirmed by Urban Institute research from 2025 showing the median wealth gap between homeowners and renters has reached a historic high. One group owns inventory, the other group only sees the cash register. And the group that owns inventory is, by every measurable standard, dramatically wealthier. They just haven't done the math. If you own a home in any form, with any mortgage balance, you are already sitting on one of the most powerful wealth-building mechanisms in American history. Not because houses are magic, but because forced savings through mortgage principal payments, combined with the general appreciation of real estate values over time, has been the primary mechanism by which the American middle class built wealth for the last 80 years. The home is not the problem. Forgetting to count, it is. I want to take a moment here to mention something, because it connects directly to what I just said about equity you can't access before you're ready. Here's the part that never makes it into a standard financial calculator. Knowing that your home equity exists and building a real plan around when and how to deploy it are two very different things. The same is true for your retirement accounts, your Social Security timeline, and the sequence in which you draw on all of these assets. I spent years surrounded by accountants and tax lawyers who did this math professionally. And even they would tell you the gap between knowing the numbers and having a withdrawal system that doesn't blow up in year 5 of retirement is enormous. That's exactly why I built a book called The Exit Code. It's an 8-chapter analysis built on 50 years of retirement data. Not opinion, not vibes. Actual math, sourced from decades of market returns, withdrawal studies, and actuarial research. 2 things in that book that connect directly to what we're covering today. First, there's a section on the dynamic withdrawal method, which replaces the 4% rule that most financial advisors still teach, a rule that was designed for a 30-year retirement in the 90s and has some serious structural flaws when you apply it to a modern early exit. And second, there's a framework I call the 58% rule, a buffer calculation that accounts for the fact that a significant share of early retirees are pushed out of the workforce before they plan to leave, not because they chose to, but because of health, layoffs, or family obligations. That buffer changes the math on what you actually need. The exit code is available through the link in the description for less than 1 hour with a mediocre financial advisor. Every year you delay, this math costs more than you think. Back to the inventory problem, because we've only counted one category of hidden wealth so far. And the second one is bigger than most people realize. The 401k situation in America is genuinely strange. According to the Vanguard How America Saves 2026 report published earlier this year, and based on 4.6 million participant accounts, the average 401k balance at year-end 2025 was $167,970. The median, the more accurate measure, was $44,115. Both are records. Now, those numbers might sound low, but here's what people forget. That's just one account. When you add IRAs, Roth accounts, defined benefit plans, and other retirement vehicles on top of it, the picture changes dramatically. Fidelity's research shows Gen X workers, that's ages 45 to 60, have an average combined retirement savings of $296,252 across their 401k and IRA. Baby boomers, $500, $6,000, $300, $2 on average. And that's just the accounts people can see on their app. Before we get to the invisible elephant in the room, Social Security. Most Americans treat Social Security like a vague promise that politicians might eventually break. They know they're paying into it, they get their annual statement, and they mostly ignore it. Big mistake. Here's how to think about Social Security from a balance sheet perspective. If you went to an insurance company today and asked them to quote you an annuity, a product that will pay you a guaranteed monthly income for the rest of your life, starting at age 67, adjusted for inflation, the price they would quote you for, the average Social Security benefit, is somewhere in the $300,000 to $500,000 range. That's what the promise is worth as a financial instrument. It's essentially a private pension that the federal government has been funding on your behalf through your payroll taxes for your entire career, and nobody counts it. The Congressional Budget Office formalized this in a working paper from 2025, specifically on Social Security and the distribution of family wealth. Their conclusion was direct. Social Security wealth is more evenly distributed than other forms of wealth, and incorporating it significantly lowers estimates of both the overall level and the growth of wealth inequality in the United States. In other words, when you add Social Security to the balance sheet, the wealth picture changes dramatically for the better for middle-income Americans. But because Social Security doesn't show up in your Fidelity account and doesn't have an app, the brain doesn't register it as real. It stays invisible, right there on the shelves, uncounted. You think the problem is that you don't have enough money, but actually, the problem is that you've been measuring the wrong pile. Now, this is where it gets uncomfortable for a different reason. Because I've been building a case that middle-class Americans are wealthier than they feel, and that's true. But there's a layer underneath this that explains why the feeling of poverty persists even when the numbers don't support it. and it has to do with the benchmark problem, which is the most insidious part of all. In about 2 minutes, I am going to show you a global comparison that will make the American wealth conversation look almost comically provincial. But first, I need to make a point that stays purely domestic, because it's the psychological mechanism that drives everything else. Here is what you are competing against when you assess your own wealth. Instagram, LinkedIn, and whatever your most financially vocal friend or relative posts about their life. The human brain evolved in communities of roughly 150 people, Dunbar's number. In that world, how am I doing relative to everyone else was a manageable question. You could see all 150 people. You had a real sample. Now your sample is 300 million people filtered through a social media algorithm specifically designed to surface the most extreme, the most aspirational, the most dramatic examples of wealth and lifestyle. Your brain runs the same software it ran on the savannah, but now the comparison group isn't 150 neighbors. It's every hedge fund manager, influencer, and startup founder who posts their Porsche in a Miami driveway. The software is exactly the same. The input is 300 million outliers. This is why a survey can simultaneously find that 73% of Americans are financially stressed, and that the median American household has nearly $200,000 in net worth and is sitting on $300,000 in home equity. The money is there. The perception is broken. And the perception is broken because the benchmark is broken. Now the global picture. Because this is the part of the conversation that tends to make people quiet. The UBS Global Wealth Report data, covering 2024, shows that approximately 1.55 billion adults worldwide had a net worth of less than $10,000. That's not $10,000 in savings. That's total net worth. Everything they own minus everything they owe, under $10,000. The total adult population of Earth is roughly 3.8 billion. So somewhere around 40% of the planet's adults have less than $10,000 to their name. Meanwhile, according to that same UBS data, the United States ranks second in average wealth per adult, $620,000 per person, trailing only Switzerland. But the average is distorted by the same Elon Musk elevator problem I mentioned earlier. Strip out the billionaires, go to the median, and the US drops to about 14th or 15th in the world, with a median individual wealth of around $107,739. That's still 14th in the world. And it still means the median American individual is wealthier than roughly 80 to 85% of adults on the planet. If you own a home in the United States, if you have any retirement savings, if you've worked for more than 10 years and have any equity in anything, a car you own outright, a paid-off appliance, literally anything, you are a wealthy person by the standards of most human beings alive today. That's not a motivational speech. That's just the math. Here's the kicker. The research also shows that 60% of the adults at the very top of the global wealth pyramid, the top 1.6% globally, those with more than $1 million in net worth, a disproportionate share of them are Americans. Around 58% of the world's millionaires, by some measures, live in the United States. So we have a country where the median person is in the global top 20 to 25% of wealth, where a massive share of the world's millionaires live, where total home equity just hit $34.5 trillion, and 77% of the population is anxious about money. That's not an economic problem. That's a perception problem wearing an economic costume. Now, let me talk about Mark again. Mark, 47, Ohio, $72,000 a year, the guy who checks his bank account balance and tells himself he has nothing. Let's do Mark's actual balance sheet together. Mark bought his house in 2012 for $190,000. He put 10% down. He's been paying his mortgage for 13 years. Based on price appreciation across Ohio markets and comparable Case-Shiller data for the Midwest, let's conservatively estimate his house is now worth $320,000. He still owes around $110,000 on the mortgage. That means Mark has approximately $210,000 in home equity. That's one pile of inventory he forgot to count. Mark's 401k. He's been contributing since he was 25. His company matches 3%. He's been a steady contributor for over 2 decades. Based on Fidelity's data for Gen X workers, average combined 401k and IRA balance of $296,000. For that age group, let's give Mark a conservative number. Say he has $180,000 in his 401k. That's a second pile, Social Security. Mark has been paying into Social Security since he was 23. At his income level, over 24 years, his projected benefit at full retirement age would be somewhere around $2,000 per month in today's dollars. To buy a private annuity that pays $2,000 per month for life, starting at age 67, you would need to write a check for approximately $325,000 to an insurance company today. That's what Mark's Social Security entitlement is worth as a financial instrument. Third pile, total, $210,000 in home equity, plus $180,000 in retirement savings, plus $325,000 in Social Security wealth equivalent. That is $715,000. Mark has $715,000 in total wealth. He sits in the same Ohio kitchen every month, stares at the $900 left after his bills, and calls himself broke. He's not broke. He's just looking at the cash register and ignoring the shelves. I want to be clear. Mark can't spend that $715,000 tomorrow. Some of it is illiquid, some of it is decades away. But wealth is not about what you can spend this weekend. Wealth is the total accumulation of assets that you have built over a lifetime that give you options, security, and ultimately the ability to exit the system on your own terms. Mark has those options. He doesn't know it yet. Now, let me give you the 2 data points that will stay with you after you've forgotten everything else in this video. First, the top 10% of American households own 76% of all wealth in the United States. That means the bottom 90% share the remaining 24%. And yet, and this is the part that matters, even within that 90%, there is enormous variation. The difference between being at the median and being at the 85th percentile is largely a function of home equity accumulated over time and retirement contributions made consistently over decades. 2 habits, not luck, not inheritance. 2 mechanical behaviors done repeatedly over time. The math rewards them with results that look, in aggregate, like Mark's invisible $700,000. Second, Americans who feel financially stressed, and I mean the high income ones, to the ones earning over $100,000 a year. Nearly 1 in 4 say inflation has strained their budget significantly, according to data from 2025. 1 in 4 people earning more than $100,000 a year feel financially strained. At the same time, those same households are statistically among the wealthiest on earth by almost every measure. The feeling of financial strain is real. The financial situation causing it is often a distortion. And the distortion is mostly driven by consumption patterns, not asset levels. The comedic version of this is a guy I know, not me, not you, definitely not a composite of 3 separate people I've met, who buys a $4,000 couch on credit, pays the minimum every month, complains that he can't save, and then tells me he needs a raise before he can start investing. The couch is the cash register. The 401k he hasn't opened is the inventory. He's running the business off one number and ignoring the other. Here is the less comedic version. Financial literacy in the United States is trained almost entirely around income and spending. The school curriculum, to the extent it exists at all, is about budgeting, not balance sheets, about cash flow, not net worth. So people grow up measuring themselves by their paycheck, their monthly expenses, their credit card bill. And nobody ever teaches them to stop and count the shelves. Nobody builds the balance sheet. The invisible ledger stays invisible for decades. That's not the school system's failure. That's an incentive problem. The financial services industry makes more money when you feel insecure, when you buy more products, when you trade more frequently. Confident people with full balance sheets and long-term plans are terrible customers. All right, 3 things you need to do after you close this video. And I'm going to be specific because generic advice is worth exactly nothing. 1, write down your actual net worth, not a rough feeling, a number. Your home value minus what you owe on it. Every retirement account, every balance. Your car, if it's paid off, subtract your credit card debt, your student loans, whatever you still owe. Add Social Security as a rough estimate. Go to ssa.gov, log into your account, look at your estimated benefit, multiply the annual number by 18 as a conservative present value approximation. Write the total. Most people who do this exercise are shocked at the number, usually in the good direction. 2, stop using income as your primary measure of financial health. Income is a flow. Net worth is a stock. A plumber who earns $60,000 a year and owns a home outright with $200,000 in equity and $100,000 in a 401k is wealthier than a marketing director earning $120,000 a year with $40,000 in credit card debt and a leased car. Stop running the business off the cash register. Look at the shelves. 3, recalibrate your benchmark. You are not competing with the top 1%. You are not competing with LinkedIn. You are not competing with the version of normal that Instagram constructed for you out of 63 carefully curated images per day. The real competition, the only one that matters, is against your past self. Are you building equity? Is your net worth going up? Is the invisible balance sheet getting bigger every year? If yes, you're winning. The score is just not the one you've been looking at. And Mark from Ohio, he is going to do this exercise. He is going to sit down, add up the home equity and the 401k and the Social Security value, and he is going to write $715,000 on a piece of paper. He is going to stare at it for a long time. And then he's going to make different decisions, not because he suddenly has more money, but because he finally counted the inventory. Lazy investing built more fortune than crypto memes. And the first move in lazy investing isn't buying anything. It's knowing what you already have. The financial anxiety industry wants you distracted and uncertain. It's better for